Hello class, this is Dr. Sharma once again. I'm going over the part 4 financial statement analysis presentation. Now in this part, I'm going to deal with learning objective number 4. As you can see, the learning objective number 4 deals with the problem of solvency. So that's what we are going to talk about, the solvency problem. Now, basically, solvency is a situation which looks at a longer term perspective of the availability of assets to pay off the liabilities in the long run. So the first ratio we'll be talking about is the ratio of fixed assets to long-term liabilities. And then the second would be the ratio of liabilities to the stockholders' equity and the times interest ratio. So those are the three ratios that I will be talking about in this presentation. So let's move ahead with the solvency. Now, what is solvency? Solvency basically evaluates a company's ability to pay its long-term debts. Now, whenever we are talking of the ability, every company can borrow and pay off its debt. So that's just transfer of debt from one pocket to another. We are not looking at that situation. We want the company to have its own resources to pay off the long-term liabilities. So that is analyzing the solvency ratio. Now, first ratio, as I said to you, we're talking of the ratio of fixed assets to long-term liabilities. Now, basically what we are trying to do is we're trying to evaluate the availability of fixed assets in the long run for a company to place as a security in support of its long-term debt. So that means whenever you want to go and borrow money from the bank or any financial institution, they will be asking for what do you have for a security. So if you have more long-term assets or the fixed assets, then possibly they will be able to finance that loan. So that's why we consider this as an important measure as to the ability of a company to pay off its long-term liabilities at maturity. So in case if you don't have any cash flow situation, at least if you have a tangible fixed assets that can be disposed of, then the lenders will be not reluctant to lend you money. In fact, they will be interested to lend you money. So that's why we are talking of the ratio of fixed assets to long-term liabilities, whereby we are going to divide the fixed assets. The net basically means net of depreciation divided by the long-term liabilities. So those are the two elements of this ratio. So let's just go back and take the example of ExxonMobil. We have been taking that. You can download 2019 annual report of the company and look at their balance sheet. Now, the information that's given to us is for the year 2019 and 2018. And as you can see, I have crossed out the investment. So whenever we take the fixed assets, we leave out the investment the company has made in the long run. So now there are two reasons why we don't consider the investment, because investments are designed in a different way. The investments in another company's assets or shares or debentures, stock, is basically designed to have a control over that company in some way. Because if you have more voting rights, you will be buying the control of that company. So that is why that investment may not be really available to place that as security, because it depends on the performance of another company. So that's not going to be very reliable pledge. So that's why what we do is we exclude that investment. So will be taking the long-term assets, and that would be basically the property, plant, and equipment, the net of depreciation. So we have a 253,018 million for 2019, and 2018 was 247,101 million. And then this is the numerator side, and in the denominator side, we take the long-term liabilities. Now, long-term liabilities, you have long-term debt, you post-retirement deferred income tax liabilities, long-term obligations, and other long-term liabilities all add up to 99,670 and $90,530 million in 2018. So the long-term liabilities are slightly more than 2018. Similarly, the property, plant, and equipment, the long-term assets, are also a little more than 2018. So you can see, however, the ratio is 2.72 and 2.54. So what does that mean? It means it has 2.5 times more assets than the liability. So that's a fairly good situation to be in the long run. So possibly banks and financial institutions will be willing to still lend more money to use because you have more assets. In 2018, you had 2.72 times. In 2019, you have 2.54 times. So it's a good situation to be in whenever you have more assets than the liability. So that is the ratio of fixed assets to the long-term liability. So we'll be considering this as a solvent company simply because it has more assets at its disposal than the long-term liabilities it has committed in the long run. So that would be your first ratio. The second ratio we'll be talking about is the ratio of liabilities to stockholders' equity, which measures the ratio of financing by debt and the equity. So the liabilities are your debt, the amount of money you have borrowed, and stockholders' equity is the amount of money your own stockholders have contributed, and any retained earnings will be added to that to calculate the stockholders' equity. So it indicates a margin of safety to the creditors. Now, if this ratio is very high, then the creditors will be little worried because the company is using their money rather than the stockholders' money. So that is why they may not be willing to really lend as much money to you as a company. So that is the interpretation of that. Now let's just take the example again of ExxonMobil. Now, as I've been saying to you, you can always download the ExxonMobil's 2019 annual report or Form 10K, whatever you get. 10K would be fine too because that's simpler to navigate. So that would be the figures that we'll be using. So as you can see, what we have done is we have taken the liabilities. So as you can see, the liabilities, of course, you have all the liabilities given to you here. So these are your total current liabilities, and you have the long-term liabilities. So the total liabilities, this is A, current liability, plus total long-term liability will give you, A plus B would give you 163,659. And then stockholders, you have the common stock, retained earnings, comprehensive income, and other elements that you have brought down, and treasury stock. Then the share of equity, non-controlling interest will give you a total equity of that amount. All right, so now what does that mean? It means now all these figures are basically known to you. Common stock is the stockholders' contribution to the company. Retained earnings is the amount of money a company has made over the years and retained in the business. And then comprehensive income and other elements are additional income or non-operating kind of income or adjustment for prior period and things like that. So that's a negative amount here. And treasury stock is basically the stock that you have purchased yourself of your own company. So in other words, you have issued the stock given to the stockholders, and some of it you're buying it yourself. Now that's one of the things that we have been really reading in the newspaper, that whenever companies get a tax advantage, they tend to buy their stock back rather than invest in property, plant, and equipment. So I did one research on that. So I found the companies were more interested in buying their own stock back whenever they had cash available to them rather than invest in property, plant, and equipment. So property, plant, and equipment actually creates jobs. But if you buy your own stock, you essentially you're not expanding your company. So that does not really create jobs for others. So if you invest in property, plant, and equipment, you are buying the capacity to create jobs. But if you're buying your own stock, you are simply reducing the outstanding stock available with the stockholders. So now, of course, companies use that bought back stock for different purposes. Sometimes they give to their employees, sometimes they reward some of the executives. So now there are different purposes they put that into use. Anyway, this is the stock that they have purchased and they are holding it themselves. So now, as I said to you, if you take the ratio between this, that is the ratio of liabilities and the stockholders' equity, as you can see, the total equity is $198,938 million, and it was same, almost the same, 198 $384, and then 147 668. Now, essentially, what it means is 0.74, that is the 74 times 0.74 times in 2018, and it was 0.82 in 2019. So that is the calculation that we have done. All right, so that is going to be your second ratio. Now we're going to go on to the third ratio. The third ratio is times interest earned. The times interest earned basically measures what is the risk that interest payments will be made even when the earnings decrease. So that means if you have, let's say, if you have $1,000 as amount of interest to be paid, but if you're making $10,000 as income, then you have a possibility of paying that 1,010 times. So what the users would be looking at in the company's balance sheet and the income statement is how much is the interest the company is making. And that is why what we try to do is we try to find out what is the amount of interest the companies have to make, and how much is the income that is being made. So a higher ratio will indicate that the company is more likely to make interest payments even when earnings decrease. So that means if you have $1,000 to pay as interest, but if you are making $10,000, now even that $10,000 decreases, let's say by half, and you're making 5,000, still there is a chance that you will be able to make that $1,000 interest payment. So that is the measure that we are going to look at. Okay, so that is the times interest earned. Let's see ExxonMobil's 2019, what you call, times interest earned ratio. So income before taxes was, of course, 20,056. and then the interest expense was 830. So what we did was A plus B, we add these two. So this is plus here, that is not visible. Plus, and then what you do is you divide by interest expense. So interest expense is again 830. So you add these two and then divide by again in the interest expense. So that is how we calculate that. So this is A plus B divided by B, not C. So that is how we'll get that ratio of 24.16 and 40.41. The income available to pay interest has gone down. So it has gone down, but it hasn't gone down to a single digit. Still it is in a double digit time. So that means what essentially it means is you were able to pay the interest 40 times in 2018. Now you would be able to pay that interest 24 times in 2019. So that is the ability of the company. So here you can see that amount has increased. So that is why now another point you can see is the income has decreased because it was 30,953 and it has gone down to 20,056. But on the other hand, the interest expenses increased. So that is why there is a decrease. So if you're an investor looking at the company, you would be little worried about this particular company because it may be overstretching after some time. So that would be the times interest earned ratio. So now what we are going to do is we are going to take a demonstration problem. So we have talked about the liquidity analysis in the previous presentation. We talked about the analysis in this. Now we're going to apply that to a demonstration problem. So let us just take the demonstration problem. So I'm going to take the demonstration problem here on the right screen, as you can see. So this is the demonstration problem. And then we are going to take the ratios one by one. So let's just read the demonstration problem. Now in the demonstration problem, as you can see, we are given figures for 2021 and 2020. So that is what we are given. And then we are given this is the income statement, sales revenue, cost of goods sold, and then finally we have a net income of 196. And then the next thing we are given is the retained earnings, statement of retained earnings. Now retained earnings, you started with 78,400 and then we added 578,400. Sorry about that. 465, 414, 2020. And then we transfer that net income from here. This is 196 and 168, 960. So that's what we brought down. And then that will give you the changes to the retained earnings. And they paid 32,000 as a preferred stock. Now, usually that preferred stock, you will be able to find out from the balance sheet as well. Let's just look at the balance sheet. If you look at the balance sheet here, it says 8%. 8% of 400,000 will be the 32,000 of preferred dividend. Now, because as we have talked about, preferred stock have a preference over the dividend, so we pay them out first. And usually that is fixed. So even if you make a lot of money as a company, you will be paying a fixed amount of dividend to the preferred stock. So that's why you have a percentage attached to that preferred stock. Now, for a common stockholder, supposing, let's say, we made a 1 million profit. Now, out of that, 32,000 we're going to pay to the preferred stockholders. So remaining 968,000 would be available to the common stock for dividend. So that is why people who want to take a risk would like to buy the common stock, but people who do not want the risk, or people who are risk averse, they usually buy a preferred stock, which gives a constant flow of money to their pocket. So that is the preferred stock and the common stock. But the flip side is when the company bundles up and it closes its business, they will be paying out, they are required to pay out the outside liabilities, and then they would pay the preferred stockholders. And then only if money is available, the common stockholders will be paid back. So that is a flip side, but nevertheless, if you take risk, you earn more. So there is always a tussle between the risk and the reward. Okay, so we are going to continue dealing with that demonstration problem. So the problem is you are given an income statement, you're given a statement of retained earnings, and you're given a balance sheet. Now what we are going to do is we are going to take the ratios. So the requirement for this segment is 10 ratios we have studied so far. We have studied working capital, current ratio, quick ratio, accounts receivable turnover, number of days sales in receivable, inventory turnover, number of days sales in inventory, ratio of fixed assets. So these we learned in this what we call part 4, and all these we learned in part 3. So if you have forgotten about the working capital, current ratio, quick ratio, accounts receivable turnover, I advise you that you go back and look at the presentation number 3. So where I talked about the liquidity analysis. So that would be the demonstration problem. So let's go and start. Now, the first one is the working capital. So if you look at the formula, working capital is current asset minus your current liability. So that is what you have to understand. Working capital is current asset minus the current liabilities. So if you go to the problem and look at, so where do you think you will find the current assets and current liabilities? Of course, in the balance sheet. So let's go and look at the balance sheet. So if you look at the balance sheet, let me clear the previous writing so that we can start afresh. Okay, so in the balance sheet, you can see, if you look at the problem, you have a current asset 1,200,000 and 800,000 for 2020 and 2021. So there's 1,200,000 and 800,000. So that's where I got that figure. Next is you're given the current liabilities. Here it says 600,000 and 520,000. So 600,000 and 520,000. And if you subtract the two, you get A minus B would be 600,000 and 280,000. So that's how we get the working capital. Remember the interpretation. What is working capital? That is the fund which is available for a business to do a day-to-day activity. Now, since the working capital is in a positive domain, we are pretty happy about that. So we have more current assets than the current liabilities. But as I said to you, for a comparative purposes, we would rather look at the current ratio. So let's look at the current ratio. Now that was the number 2 requirement. Current ratio is, of course, you divide the current assets with the current liabilities. So that will give you a current ratio. And I have been saying to you, a rule of the thumb is that if you have a current ratio of 2, you are pretty okay with it. But if it is less than 2, or if it goes down below 1, then you should start worrying about the particular company. So now here we have the current assets, same 1,200,000 and 800,000, and then 600,000 and 520,000. So if you divide the two, you will be getting 2.0 for 2021 and 1.54 for 2020. So as compared to 2020, we are doing better in the current ratio in 2021. So whenever you're working on your PVL activities, that's what you're going to do. You're going to compare the two ratios, compare the ratios between the 2 years of the same company, as well as you will compare those ratios for the other companies. So since you're working on two companies, that's how I expect you to do the analysis. Okay, so the current ratio is 2, and as compared to 1.54 in the previous year. So that is your current ratio. Now the next ratio is the quick asset ratio. Now again, I have been telling you the quick asset is, we also call it as an acid test ratio. It really tests the ability of a company to generate cash in a very short period of time when there is a need. So we'll be taking the quick assets. Current liabilities remain the same. So as we already know, the current liabilities were given 600,000 and 520,000. And then the quick ratio you'll be calculating by dividing the quick assets. So now in the quick assets, again, we go to the balance sheet and look at what are the assets that can be converted into cash in a very short notice. Now, the inventory is something that you have not been able to sell off. So now you won't be able to sell off, because if you are not able to sell in the past, you won't be able to sell it now as such in a short notice. So that's why we'll exclude that. And we'll also be excluding any prepaid expenses. These are some committed expenses that you have done, and you possibly can't ask back that money. So that is why we exclude them from the list of quick assets. So in our case, the balance sheet here for the company shows that we have cash, we have temporary investments, cash, temporary investments, and accounts receivable. So I'm not taking the inventory, and I'm not taking the prepaid expenses. So there are two ways of doing it. Either you add up the three, that is cash, temporary investment, and accounts receivable, or you start with the total current assets and subtract the inventories and prepaid expenses. So that's how we'll calculate that. So we calculate, if we just add, I have deleted the prepaid expenses and inventory, of course. And so we have cash, temporary investment, accounts receivable. These three add up to 600,000 and 400,000 for 2020. Current liabilities remain at 600,000 for 2021 and were 520,000 for the year 2020. So that gives you a ratio of 1 and 0.775. So that is how we'll be calculating the quick ratio. So that is another way of looking at the liquidity situation. Okay, so now let's move on to the next one. Before I move on, again, the liquidity ratio, the quick ratio shows that our ratio was 0.77, and now it has gone up to 1. So we are actually improving our ratio. And as I've been saying to you that if the current ratio is about 2, we are okay. And if the quick ratio is about 1, we are okay. 1 means we have the same amount of current liabilities as compared to the quick asset, which could be converted into cash and used to pay off those current liabilities. So the liquidity wise, we are good with that. So that would be your quick ratio. Now, the next ratio we are going to do is we are going to calculate the accounts receivable turnover ratio. Now, accounts receivable turnover ratio is sales divided by average accounts receivable. Now, this is a composite ratio, as I call it. Why we call it as a composite is because your sales figure comes from income statement and accounts receivable comes from balance sheet. So I have to look at the two different financial statements in order to calculate that ratio. So that's why, okay, so now what will happen is if you look at yours, let me go to, okay, we're doing accounts receivable turnover ratio, and we know the sales was 4 million and 2,560,000. So that is how I got that. So this is from the income statement. So from the income statement, I got that figure of 4 million and 2,560,000. And then I had, if you go to the balance sheet, look at the balance sheet. The balance sheet, it shows that you have accounts receivable of 340,000 and 260,000. So 340 and 260,000. So if I average this, that will be this plus this divided by 2, I get 300,000. And therefore, I get a turnover ratio of 13.33. Now, while discussing the concept, I told you if you're able to roll your accounts receivable number of times, it is better. So, of course, you're rolling it 13.33 times in a year. So that would mean that you're selling goods and collect goods on credit and collecting that money. So that means you're rolling your accounts receivable fairly good. Now, as I had said to you, it depends upon the type of a business. If you're building a big airplane and selling it, probably your turnover ratio is not going to be this high. But if you are a grocer or if you are a consumable item dealer, then of course your ratio could be, this could be a little lower. So it depends upon which kind of industry and which kind of business you have to really be able to tell whether this ratio is good or not. So now that is 13.33. So we consider that fairly good ratio because 13.33 is a fairly large number. So that is your accounts receivable. But again, to be very precise about the interpretation, we won't be able to tell. Either you have to make a comparison for the previous year or you have to make a comparison with another company. Now, since for 2020, I don't have a 2019 what you call sales figure, I won't be able to calculate the receivable turnover. So that's why we are able to calculate only for 2021. So whenever you have that situation, that's what you need to understand as well. Okay, so that would be your accounts receivable turnover ratio. Now we go on to the next ratio. That's the number of days sales in receivable. Now, number of days sales in receivable is, of course, it gives you the same idea. Now, I told you there are two ways of calculating the ratio. Either you divide 365 by the accounts receivable turnover ratio. If you calculate that, it comes to 27.38 days. So essentially, we are taking about a month to roll over your accounts receivable. So we buy goods and we sell them on credit and we collect them. So the whole process is taking around 28 days. So that would be 27. So to be approximate, probably a month is the number of days sales in receivable. Now, I also gave you an alternative formula. So the alternative formula would be, what you will do is you will be dividing the average accounts receivable with your average daily sales. So we have already calculated the average accounts receivable for the previous calculation. We got that at 300,000. So we can use the same figure here. So that's 300,000. And we know the sales is 4 million, and divided by 365 will give you an average daily sales of 10,000 958.90, and then you divide this 300,000, that is your average accounts receivable, with the average daily sales. So that will again give you, so you can see we get the same number of days, whether you are using the first formula or the second one. Now, normally the advice that I give it to you is, if you are doing both accounts receivable and number of days sales receivable, I would go with the first one because it's easier to calculate. But if you're only doing the number of days sales and receivable, then you're better off calculating using the second formula. So that would be how we'll be calculating your number of days sales and receivable. Now let's move on to the next ratio, that is the inventory turnover ratio. Now, in case of inventory turnover ratio, the formula is cost of goods sold divided by average inventory. Now, if you are a trading and a manufacturing company, cost of goods sold will be directly given to you. Otherwise, you may have to calculate the cost of goods sold. So the cost of goods sold divided by average inventory. So we're given the inventory 76,000 and 384,000. Again, from where do you get that inventory amount? From the balance sheet. So if you look at your problem, here it is the inventory amount. So this is the inventory amount. So that's 576,000 and 364,000. So you can see that this is 576 and 384,000. So if you add those two and divide by 2, you will be getting 480,000, and 2,720,000 divided by that 480,000 will give you 5.67 times. So you are rolling your inventory about 6 times. So that is the interpretation is you are able to buy the inventory and dispose of the inventory about 6 times in a year at an average. So that's the interpretation, and higher the better. So again, as I said to you, I could not be exact as to whether this is a good ratio or not unless I have a benchmark. The benchmark could be my previous year's performance or the performance by the other company. If you're doing your PVL activity, then you would be comparing this with the second company that you're working with. So that will give you an idea which company is doing better in terms of inventory. So how fast is it able to roll its inventory? So that is your inventory turnover ratio. The next ratio, the last of the liquidity ratios, is number of days sales in receivable. As you can see, 365 divided by the inventory turnover ratio. That is what you call the formula that you can use. Days in the year is 365. We calculated that ratio to be 5.67 in the previous slide, and we get 64.41. So it is taking about 2 months really to roll your stock. So now if you are a Walmart store, you should be worried about that, because your philosophy is to buy goods and sell them off and sell them in bulk so that you would be able to make a profit. But if you are, let's say, Airbus or a Boeing company, then you would be really happy with that, what you call turnover. So that is the number of days sales receivable turnover ratio. Now, as I said to you, in case of a number of days sales in accounts receivable, in this case also you have an alternative formula. So the alternative formula is average inventory divided by average daily cost of goods sold. So average daily cost goods sold is cost of goods sold divided by 365. So in the previous slide, we already know we calculated 480,000 as the average, because your inventory was given to you as 576 and 384,000 for 2020. Add them up and divide by 2, you get 480. And then the cost of goods sold was 2 million. Of course, the cost of goods sold, I got it from your income statement. So if you look at the income statement, I'll be able to get that 2,720,000 as the cost of goods sold. So that divided by 365, I get a daily cost of goods sold of 7,452. And if I divide again the average inventory, that is average inventory divided by the average I just calculated, that's the average daily cost of goods sold, I'll be getting 64.41. So it is the same number of days as we calculated using the previous formula. So that is your number of days sales receivable. Now the next one we're going to talk about is the ratio of fixed assets to long-term liabilities. Now the ratio of fixed assets to long-term liabilities we just talked about in this presentation, so I'm not going to spend much time again repeating the same thing I've said, but nevertheless we'll use that problem and calculate your ratio. So property, plant and equipment was given 1 million. So that one again, I'll have to go to the balance sheet. You can see this one here, property, plant and equipment was 1,674,400 and 1,558,400. So those are your property, plant and equipment given to you. And your long-term liabilities were two of them. So that is your mortgage and the bonds payable. So mortgage was nothing in 2020. You borrowed 328,000, that's a mortgage payable. 640 was the bonds payable, same amount last year as well. So the long-term liabilities would be, if you add these two, you get 968,000 and 640,000, and you get a ratio of fixed assets of 1.73 and 2.44. So that would be your ratio of fixed assets. Now again, as I said to you previously, if you have more assets, then the lenders are going to be willing to lend money. As you can see, your ratio was 2.44 in the previous year. That's why you got a mortgage of 328,000. Now in this year, if you go to borrow, they may not give you because your ratio has come down significantly. So that is your ratio of fixed assets to the long-term liabilities. Now, the next ratio we talked about in this presentation is ratio of liabilities to stockholders. Now, in this, what we are trying to do is, what is the proportion of liabilities and equity that is comprised of a liability, whether it is increasing or decreasing. So that's what we want to see. And in our case, we have seen it is increasing. The proportion is increasing from 0.84 to 1.04 because we incurred a mortgage of 328,000. So that is why that is creating that situation. So the current liabilities were 600 and 520. And then the long-term liabilities were, of course, your mortgage and bonds payable. So the total liabilities would be this amount: 1,568,000 and 1,160,000. So that is, if I add these numbers, that's what I get. And then I have preferred stock and common stock and retained earnings. That's the total equity. So if I add these three, I'll get the total equity. So if I divide, of course, the liabilities with the equity, then I will be getting that 1.04 because the liabilities are slightly higher than your stockholder equity. So that is your ratio of liabilities to stockholders' equity. Now, normally stockholders would like to use the borrowed funds rather than their own, because there is always a question of leverage, because if you have to pay interest, you will be having that in mind. So probably you will be working harder to earn at least that amount of money. So that's why there is always a push and pull. The investors would like to borrow and run the business. The creditors would like the stockholders to paying more money than theirs. So that is always a pull and push. So that is your number 9 ratio. The last ratio is the times of interest earned ratio, that is income before income tax plus the interest expense divided by the interest expense. So now, as I said to you, this measures what is the available income to pay the interest. Now, of course, interest you will be able to get it from the income statement. So if you look at that, here we have interest and the debt expense of 84,000 and 51,200. So that is the interest. So income before income tax was 436 and 309,760. So that is here given to you. So if you add them up and divide by, again, that should be divided by B, that should be divided by the interest. So you add these two and divide by this number. So add them up and divide by that number will give you 7.05 and 6.19. So that's how we get that ratio. And as you can see, the income available to pay interest has gone down because it has gone down from 7.05 to 6.19. So that should be a little worrisome to the lender. So that is how we'll be calculating these ratios. So now in this presentation, I explained to you the solvency ratios, the 3 solvency ratios, and took a demonstration problem and showed you how you could calculate the solvency ratios as well as the liquidity ratios we talked about in the previous presentation. So now I'm going to take up other issues in this chapter in the next presentation. So thank you for listening to the presentation, and hope you will find them useful.